Most people don't fail at investing because they're lazy or incapable. They fail because no one ever taught them the correct order. They jump into stocks because someone on social media mentioned a hot company. They try real estate because a friend said it builds wealth. They experiment with crypto because it sounds exciting. And years later, they look back confused, wondering why their money feels scattered instead of growing. Here is the uncomfortable truth. Investing without order is one of the fastest ways to stay broke slowly. Not because investing doesn't work, but because randomness destroys momentum. So before we go deeper, take a moment to like this video, subscribe to the channel, and comment in order below if you're serious about building wealth with structure instead of emotion. Because today, we're breaking down the best way to invest your money, calmly, logically, and step by step. The first mindset shift you need to make is this. Investing is not about chasing the highest return. It is about building financial stability layer by layer. Most beginners think investing starts in the stock market. It doesn't. Investing starts with protecting yourself from collapse. Because if your financial life is fragile, no portfolio strategy can save you. Here's what most people misunderstand. Stability is the foundation of growth. Without stability, every unexpected event forces you backward. So the first place your money should go is your emergency fund. Not because it earns high returns, but because it protects your future investments. You need several months of essential expenses saved in a safe, accessible place. Why? Because life is unpredictable. Jobs change, expenses appear, markets fall. If you invest without a cash buffer, you may be forced to sell investments at the worst possible time. An emergency fund gives you breathing room. It allows your long-term investments to stay invested. Now pay attention to this part carefully. Emotional control in investing starts with financial stability. When you know you have cash reserves, market volatility feels less threatening. You don't panic. You don't sell out of fear. Stability creates patience. Once your emergency fund is in place, the next investment is not a stock. It's eliminating high-interest debt. This is where beginners go wrong. They try to invest while carrying expensive credit card balances. But if you're paying high interest, that interest is working against you every single day. Paying off high-interest debt is a guaranteed return equal to the rate you're eliminating. Few investments offer that level of certainty. Removing that burden increases your monthly cash flow and reduces stress. It strengthens your foundation before you begin building upward. After you have stability and have eliminated high-interest debt, this is where true investing begins. And here, simplicity wins. Instead of trying to outsmart the market, the disciplined approach is to own a broad piece of it. Diversified, low-cost index funds allow you to participate in overall economic growth rather than betting on individual winners. This reduces the pressure to predict. You are not asking which company will dominate. You are aligning yourself with long-term productivity and expansion. This is where many people complicate things unnecessarily. They believe simple means unsophisticated. But over decades, broad diversification combined with consistency has historically outperformed emotional stock picking for most individuals. The key is regular contributions. Investing monthly, regardless of market conditions, smooths volatility over time. When prices are high, you buy fewer shares. When prices are low, you buy more. The discipline remains constant. Here's what most people underestimate. Time matters more than timing. Waiting for the perfect moment often results in years of delay. Consistency beats perfection. The earlier you start and the longer you stay invested, the more compounding works in your favor. Now, once your diversified long-term investments are automated and growing, the next layer becomes tax efficiency. Depending on your country, retirement accounts or tax-advantaged vehicles can significantly increase long-term growth by reducing the drag of taxes. This may not feel exciting, but over 20 or 30 years, tax efficiency compounds quietly. Small percentage improvements today can translate into meaningful differences later. Only after these core layers are solid should you consider expanding into additional asset classes such as real estate or selective higher-risk opportunities. And this is critical. These expansions should represent a smaller, controlled portion of your overall portfolio, not the foundation. Too many beginners reverse this order. They jump into complex investments before mastering diversified long-term growth. Complexity without structure increases risk. Now, pay attention to this part because it's subtle but important. Order reduces emotional mistakes. When you know exactly where your next dollar goes, you eliminate hesitation. First emergency fund, then debt elimination, then diversified investments, then tax optimization, then expansion. Clarity reduces impulse. Let's talk about common mistakes in more detail. One mistake is investing aggressively while having no financial cushion. Another is carrying expensive debt while trying to chase market returns. A third is over-diversifying too early by buying random assets without understanding allocation. And perhaps the biggest mistake is abandoning the plan during downturns. Markets will decline. That is normal. But if you sell in fear, you interrupt compounding and lock in losses. This is where emotional discipline becomes central. Investing is less about intelligence and more about behavior. When markets drop, your instincts will tell you to retreat. When markets surge, your instincts may tell you to take excessive risk. The disciplined investor does neither. They continue contributing according to their system. They review periodically, not obsessively. They think in decades, not months. And here is something else that rarely gets discussed. Your investment order should align with your stage of life. If you are early in your career, your greatest asset is your earning power. That means consistency and growth in contributions matter more than complex allocation strategies. If you are closer to retirement, protecting capital and managing volatility becomes more important. The order remains the same, but the emphasis shifts slightly based on your timeline. Investing is not static. It evolves with you, but the foundation never changes. Another layer to consider is clarity of purpose. When you invest without a defined long-term goal, it becomes easier to abandon the plan. Are you investing for financial independence, retirement security, generational stability, or flexibility in your career choices? When your investments are tied to a clear purpose, discipline becomes easier. You're not just moving money into accounts. You are building future options. And here's what most people misunderstand about wealth building. It is not about maximizing excitement. It is about minimizing regret. Regret often comes from emotional decisions made during temporary conditions. Selling in panic, buying in euphoria, taking on too much risk without a safety net. Following the correct order reduces the chances of those regrets. It builds confidence slowly, because every step reinforces stability. So let's expand the recap clearly and calmly. First, protect yourself with an emergency fund so that life does not derail your investments. Second, eliminate high-interest debt so your money stops leaking. Third, invest consistently in diversified long-term assets and automate the process. Fourth, improve tax efficiency and reduce friction where possible. Fifth, expand cautiously into additional opportunities only after your base is solid. This is not flashy, it is not dramatic, but it is durable. Investing is not about brilliance, it is about sequence. When you respect the sequence, you protect your downside and allow your upside to compound over time. If this framework brought clarity to your investing journey, like the video, subscribe to the channel, and comment "Structure First" below so I know you're committed to disciplined wealth building. And if you want to understand why patience and consistency matter more than intensity, watch the video titled, "What if you invest $100,000 in the best 5 ETFs?" Because once you truly understand compounding, you'll never invest out of order again.